It's getting ugly out there. The AI bubble was never sustainable, and now the air is coming out fast. Markets are sliding, and reality is getting harder to ignore. We're seeing a serious liquidity squeeze with heavy selling across the board. Screens are red everywhere, and it's starting to feel a lot like 2008 again. The S&P is down, the Nasdaq dropped 2%, Cisco fell 10%, and even Apple is down 5%. This sell-off isn't random. There are deeper problems building under the surface. Yes, the recent jobs report looked strong, but the real economy tells a different story. There simply isn't enough money flowing to keep propping up asset prices. The biggest warning sign? Rising consumer delinquencies. People have borrowed too much, and many can't keep up with payments. Delinquency rates are climbing toward 5%, with severe defaults moving closer to 2008 levels. And since about 70% of U.S. GDP depends on consumer spending, that's a serious threat. When people can't pay their loans, they're not spending at stores or restaurants. Home sales just dropped 8.4% last month. Between high interest rates, expensive imports from a weaker dollar, and heavy tariffs, households are squeezed from every side. The market is finally waking up to a simple truth. Consumers are stretched thin. Inflation is becoming structural, pressure is building, and many assets still look overpriced given what's coming next. Markets are basically priced for a perfect outcome. Investors believe inflation will fall back to 2%, but it hasn't. It's been stuck around 2.5% for 6 months, and even high interest rates aren't pushing it lower. That tells you long-term rates could stay high. Even if the Fed cuts rates to zero, it may not matter. The economy is already under pressure from the trade war, and inflation looks more structural now. That's bad news for markets because big investors are still betting that rates will eventually fall. The bigger issue is denial. The administration won't admit tariffs are adding to the cost of living crisis. Instead, they blame the previous leadership. But blame shifting doesn't fix inflation. It just suggests the trade war will continue and rates will remain elevated. And who gets hit hardest? Highly indebted sectors, especially big tech and the AI hyperscalers. The U.S. doesn't have many strong advantages left. Manufacturing is weaker, finance is under pressure, and the dollar has struggled. There's a growing belief that without AI and tech growth, the economy is in serious trouble. Even Elon Musk has warned that without AI and robotics driving productivity, solving the national debt becomes almost impossible. The problem is this desperation is tightening liquidity across the system, and that's where the real stress begins. Big tech companies in the United States and around the world are racing to raise huge amounts of money to build AI data centers. To do that, they're issuing a massive wave of bonds. But when tech floods the market with debt, it pushes everyone else aside. Even the U.S. government. Treasury debt could end up being repriced higher because there's just too much supply. The bigger problem is that money is being pulled out of other parts of the economy to fund AI. In 2026 alone, hyperscalers plan to spend over $600 billion on AI, much of it financed through bonds. Tech now makes up about 12% of total bond issuance, far higher than during the dot-com era. If interest rates stay high, this becomes dangerous. These companies still have to pay interest, whether AI pays off or not, and if rates don't fall, they can't refinance cheaply. That's when the pressure really starts. Now the stress is spreading. Investors are selling whatever they can, even gold and silver, to cover losses elsewhere. Gold suddenly dropped $150 in a sharp move, likely driven by automated trading. This looks like a liquidity crunch, where even strong assets get sold to support weaker ones. The tech sell-off is now spilling into everything. There's no easy place to hide. Even bonds don't look safe if yields stay high. That's the real issue. The dollar, which backs U.S. bonds, keeps losing value. And current policies are pushing things closer to the edge. The debt problem isn't going away. The government will have to keep issuing more bonds to cover spending. Tariff revenue won't last, and even now it's not making a big difference. Spending is projected to be $1.3 trillion higher than expected, while revenue could fall by nearly $50 billion. That means we're spending more and earning less. By 2036, the deficit could reach 6.7% of GDP. That's huge. If bond issuance keeps rising, interest rates will likely stay high. That puts pressure on everything. Big tech, small businesses, everyone. Unless there's a major productivity boom, the economy could hit serious trouble. There's talk about shifting industries back to the U.S., but That won't work if the fundamentals are weak. If inflation and interest rates stay high, how are companies supposed to make solid profits? Consumers are already stretched, and building new factories requires billions, often borrowed at high rates.
We're going to see as these, I don't know if you notice also construction numbers, the jobs for construction workers. You know why? Because they're building plants all over the United States. That's why. And when these plants open in a year from now, some sooner, some a little bit later, but when these auto plants, AI plants, and thousands of other types of plants, when they open over the next period of a year, year and a half, you're going to see numbers like we've never seen before in this country. Thank you very much, everybody.
Now, while all this is happening, there's another problem hitting the tech market. Japan's prime minister just won the election, and that likely means more spending in Japan. Bond yields there are rising, and that's bad news for the yen carry trade. This is a serious risk hanging over U.S. markets. Here's why it matters. For years, investors borrowed cheap money in yen and used it to buy U.S. assets, especially tech stocks. But now Japanese rates are rising and U.S. stocks are falling. That trade suddenly looks very dangerous. Would you borrow money at interest to buy tech stocks that are crashing? Most investors won't. There are still hundreds of billions of dollars tied up in this trade, supporting markets like the Nasdaq. But that support is getting weaker. There's also currency risk. Hedge funds are no longer betting against the yen. They're starting to bet on it, strengthening. The dollar has already fallen about 4% against the yen in the past month. So if you borrowed in yen to buy U.S. stocks, you're already down 4% from currency moves alone, plus another 2 to 3% in interest costs. And if U.S. stocks keep falling, the losses could pile up fast. Markets keep falling, and it's getting worse. This feels like a triple threat. And it makes you wonder how long the yen carry trade can really last. If this trend continues, Japanese investors may start dumping U.S. assets and move their money back home, even into Japanese stocks. Right now, it looks like money is rotating out of U.S. stocks. Some is going back to local markets, some into gold, some into silver. Volatility is exploding, and that tells you investors are nervous. Big daily swings, even 2 to 5% drops, could become normal. According to Goldman Sachs, investors aren't just selling. They're heavily shorting the market. Hedge funds are actively betting on U.S. stocks falling. There's massive short interest and record levels of selling, worse than anything we've seen since 2016, even more intense than during the pandemic. And it's not just tech. Financial stocks are getting hit too. On top of that, AI fears are growing. Many worry that artificial intelligence could replace jobs. If companies automate too fast, job losses could rise, spending could fall, and that could hurt the economy. Right now, fear is driving the narrative, and we haven't even talked about geopolitical risks like rising tensions with Iran. If that escalates, markets could react fast. So the big question is, do U.S. stocks fall further? And is the yen carry trade already quietly unwinding? Let me know what you think. Stay safe, and don't forget to like and subscribe as we navigate these crazy times.